You come to the market obsessed with the money you might make. You look at charts and see expansion, profit targets, and the fantasy of a doubled account. This immediate focus on the P and L is the cancer that consumes every new trader and starves every account. You begin trading looking at the ceiling, but the true master always keeps his eye on the floor. The rookie only calculates how much he can win. The veteran calculates how much he can lose. This fundamental difference is the sole line separating the professional speculator from the emotional amateur. Your greatest danger is not the market, which is an objective force. Your greatest danger is your own greed and your own hope. They are the twin betrayers that demand you disregard the only thing you can truly control, your risk. They sell you systems based on mythical entry points, but the entry is a trivial matter. The true architecture of speculation is built on what you do before you commit a single dollar. If your trading plan prioritizes the potential upside over the codified, immutable control of the downside, then your plan is worthless. It is a suicide note disguised as a business proposal. The market has one objective: to separate the unprepared fool from his capital. It does this with brutal efficiency, testing your resolve the moment you are weakest. You must define the cost of your speculation before you ever enter the arena. You must know your absolute maximum pain point, and you must know your required volume before you hear the first bell. Anything less is not trading. It is a desperate form of self-sabotage. The foundation of my entire career, the single principle that allowed me to survive the cycles that swallowed empires, is this: pre-commitment to capital preservation. This is not a suggestion. It is a covenant with your own future. If you cannot live by this covenant, you cannot survive the market. Before you touch the execution button, two things must be mathematically fixed: the maximum permissible volume of your position and the predetermined price exit point. These are the two anchors that prevent the storm of emotion from dragging your account to the depths. They are the mechanisms that enforce systematic psychological detachment from the outcome. Let us speak first of the most ignored variable: position sizing. This is the initial firewall against financial ruin. Yet most traders treat it as an afterthought. They determine how much they feel like buying, or how much they think they can afford to lose on a percentage basis, often after they have already located the trade idea. This is the reverse of discipline. The professional trader defines the risk percentage first, not the dollar amount. I do not care what the stock is. I care only about the percentage of my total capital I am willing to risk on any single trade. That percentage is sacred. It is your ultimate line of defense. It must be small, agonizingly small, because capital preservation is the primary duty of the speculator. You cannot risk 2%, and you certainly cannot risk 5%, because the mathematics of drawdowns are brutal and unforgiving. If you lose 50% of your capital, you must then make 100% just to get back to even. The recovery curve is exponentially steeper than the loss curve. This truth alone mandates that your risk per trade must be fractional, tiny, and absolute. I used to use a fraction of 1%. Knowing that even a string of 10 successive losses would only marginally degrade my base capital. This allowed me to stay in the game long enough for the inevitable winning trend to manifest. You must survive to participate. You must preserve your ammunition for the high conviction signals. Reckless sizing is simply throwing money into a furnace. The amateur buys a fixed number of shares based on what looks reasonable for his account size. The professional calculates the absolute worst-case scenario, the distance from his entry to his stop-loss. He then divides his maximum allowable dollar risk by that distance to calculate the maximum number of shares he is permitted to purchase. The entry price is irrelevant. The stop price is the reality. This calculation is the only correct way to size a trade. It guarantees that if the market proves you wrong, your maximum capital loss is always the predefined, manageable percentage. The calculation ensures that the market does not dictate your losses. You dictate your losses. This separation is the essence of control in speculation. Now let us turn to the second anchor, the stop loss. This is not a suggestion box. It is the execution order for a failed idea. The stop loss defines the exact price point at which your original thesis has been definitively proven incorrect. It must be placed not where you hope the market will hold, but where the market structure absolutely invalidates your premise. If you are buying a breakout, the stop must be placed beneath the prior support structure. If you are buying a pullback, the stop must be beneath the key pivot point that defined the preceding move. It must be a price level that signals an objective change in the supply and demand dynamics, not an arbitrary percentage point on your chart. This distinction is critical. A professional stop is based on structure. An amateur stop is based on hope or an arbitrary dollar amount. The amateur places his stop too close, gets whipsawed out of a perfectly good trade, and then chases it higher. Or worse, he places it too far away in a place that allows a small, manageable loss to metastasize into a terminal wound. You must place the stop and immediately forget it. It is your protective wall built before the battle begins. The professional trader knows that every trade is a speculation, a calculated wager, and that many will fail. The stop loss is the market's tuition fee. It is the cost of doing business, and it must be paid without hesitation or emotional appeal. The most corrosive behavior in the market is the refusal to accept a loss. The amateur watches the price drop, feels the immediate psychological pain of being wrong, and then commits the ultimate sin, averaging down. He buys more shares at a lower price, desperately hoping the average cost will be met by a swift reversal. This is not trading. It is an act of faith, and the market is not a sanctuary. Averaging down is a refusal to admit error. It is a compounding of mistake upon mistake. It is an emotional plea to the market, and the market only understands price and volume. The result of averaging down is always the same. A small, acceptable loss transforms into a catastrophic, account-crippling liability. I have seen fortunes extinguished this way. Never reinforce a losing position. Never. There was a time, early in my career, when I had already learned the intellectual lesson of the stop, but I had not yet internalized the emotional one. I had taken a large position in a fast-moving stock, a speculative play on an emerging industry. I had done the math. My maximum acceptable risk was defined, and the stop was correctly placed beneath a key price level. The position moved against me, swiftly and violently. The stock sliced through my predetermined stop price like a knife through soft butter. My system demanded execution, but I hesitated. The reason for my hesitation was shame and a deeply ingrained financial regret. I had too much of my capital in the position, violating my own primary sizing rule, but I had rationalized it away. I looked at the chart, and instead of clicking the execution button, I moved the stop down, just a fraction. I told myself the move was just an overshoot, a temporary shakeout of weak hands. I justified the move with technical nonsense, but the real reason was fear, the fear of realizing a substantial loss. I was no longer trading the chart, I was trading my emotion. The stock did not pause, it accelerated downward. Now the loss was double the size I had initially deemed acceptable. The psychological pressure became immense, a cold, crushing weight on my chest. I averaged down, buying a second block of shares, convinced that the price was now cheap and that the rebound was inevitable. I was no longer a speculator, I was a gambler praying for a miracle. The final descent was brutal. The company's underlying fundamentals were questioned and the stock went into a free fall. When I finally hit the button, days later, the loss consumed a quarter of my entire capital base. A trade that should have cost me less than 1% had, through emotional manipulation and a failure of pre-commitment, cost me months of successful work. I had allowed one single speculation to threaten my ability to ever return to the arena. That experience was the most expensive education I ever bought. It taught me that the market does not care about your hopes or your shame. It only respects the cold, mechanical application of rules. I had violated both of the cardinal rules. I oversized the position, which made the stop psychologically impossible to honor, and I refused to accept the market's verdict. The loss was not the market's fault. It was a self-inflicted wound. The conclusion from that catastrophic trade is unambiguous. The market has no sympathy for hope. The loss is finite only if you make it so. You must define the risk, and you must adhere to it with the cold, unfeeling precision of a machine. If your system tells you to exit, you exit. There is no appeal. There is no second guessing. The only way to survive to trade the next opportunity is to ruthlessly preserve your base capital on this opportunity. The market will always return with another chance. Your capital, once destroyed, may not. Risk management is the only prediction you can truly control. You cannot predict the price movement. You can only predict your own response to it. The discipline you show in controlling your volume and honoring your stops is the only measure of your fitness to speculate. It is not the cleverness of your entry that sustains you. It is the absolute certainty of your exit. The market tests you every day, and its primary test is not technical. It is psychological. It is a test of your character, your resolve, and your willingness to admit error quickly. The man who cannot take a small loss will eventually take a gigantic, ruinous one. Your ability to cut your losses short must be instantaneous, automatic, and without remorse. Think of the stop loss as the cost of the ticket to the show. You pay the ticket, you watch the show, and if the actor forgets his lines, you quietly leave the theater. You do not storm the stage and demand a refund. Most traders spend 90% of their time searching for the perfect entry and 10% thinking about the exit. The professional spends 100% of his time thinking about the exit, because the exit is the only thing that guarantees the survival of the speculator. Reverse this ratio in your mind, and you reverse the trajectory of your trading career. Your trading plan must be a document of control, not aspiration. It must be a set of mechanical instructions for your execution. It must include the specific formulas for position sizing that force your risk to remain fractional. It must codify the structural points for your stops that remove all emotional subjectivity. This plan and its ruthless application is the only moat that stands between you and the market's relentless attrition. The market only gives large rewards to those who first prove they are capable of surviving the large risks. Survival is the only prerequisite for success. All speculation comes down to this single brutal reality. You cannot win the game if you're not allowed to play. And you are only allowed to play for as long as you preserve your capital. Discipline is not a feeling, it is an action. It is the action of closing a position at a loss because your pre-commitment demands it. It is the action of resisting the urge to oversize a trade no matter how certain you feel. Certainty is the market's deadliest trap. You must replace certainty with probability, and you must replace hope with discipline. The difference between the professional and the amateur is that the professional executes his plan without question, and the amateur questions his plan the moment the price moves against him. Do not be the amateur who allows his account to contract because he cannot bear the psychological contraction of being wrong. Risk management is the acknowledgement that you will be wrong, often, and that the only measure of your professionalism is how little those errors cost you. Your ultimate account trajectory is determined by your adherence to these simple, powerful, and utterly uncompromising rules. Preserve your capital. Size your trades small. Honor your stops instantly. These are the three pillars upon which a speculative career is built. Everything else is noise. Ignore the noise. Focus on the foundation. If these words hit you, it means you're not here by accident. Subscribe now, like this video, and leave a comment. That simple action helps more people find this content, and it tells me that my work still matters. But the battlefield of the market is the mind, not the chart. If you want to understand the true psychology of speculation, you must read the one book that defines the game. I'm talking about Reminiscences of a Stock Operator. It is not historical. It is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below.